For investors, inflation poses unique concerns. Even if the value of your investments increases, inflation reduces the value in the long run. The only way to cope with it successfully is to make sure your money is invested in investments that will benefit from inflation while avoiding those that will be particularly heavily hit. So, how do you locate assets that gain value rather than lose value as a result of inflation? Consider the following 6 inflation-proof investments. Be sure to listen all the way to the end to avoid any misunderstanding. Investments that are inflation-proof. Why could inflation be a problem? The economy is showing signs of deflation, owing to the sharp drop in oil prices. Businesses are also decreasing employees or shutting down to prevent the coronavirus from spreading. However, things could abruptly alter. Fearing a significant economic slump, the government and the Federal Reserve are doing everything they can to infuse liquidity into the economy and financial markets. As trillions of dollars in additional money enter the economy, inflation of the US currency is a distinct possibility, though it may appear impossible right now. After all, the primary goal of liquidity injections is to maintain the value of financial assets while also getting money into the hands of consumers. The goal is to keep the financial markets from collapsing further and to avert a widely anticipated economic downturn. The majority of these initiatives are comparable to those implemented in the aftermath of the financial crisis of 2008. Even so, there's no guarantee they won't result in inflation. Why are inflation-proof investments value for money? When it comes to investing for inflation, there are no guarantees. Certain investments may, at best, be inflation-proof, but returns cannot be guaranteed. This is especially true in the current quickly changing coronavirus-driven financial landscape. A deflationary tendency will almost certainly prevail if employment, and thus spending, continues to drop. However, a rapid return to pre-coronavirus levels of economic activity, along with trillions in government stimulus, might produce the perfect storm of increasing inflation. While it's probable that the majority of the stimulus would end up in financial markets, raising asset prices, enough of it will end up in consumers' pockets to reverse the 40-year deflationary trend. We can't rule out the chance that if the current crisis worsens, investors would be unwilling to return to the financial markets. Any one or a combination of the following asset classes may prove to be a winning strategy in that scenario. 1. Keep cash in money market tips or in money market funds. If you think inflation will be an issue in the future, you should invest in money market funds or a high-interest cash account like Unify Money. Money market funds are the cash investment of choice during periods of rising inflation, despite the fact that they currently pay next to nothing. There are 2 good reasons for this. Because the rates they pay fluctuate with interest rates and shift upwards automatically when interest rates rise. There's no reason to go after higher yielding cash assets. Money market interest rates rise with the broader market, so you won't lose market value like fixed rate investments do during inflationary periods. Money market funds are interest-bearing investments, and that's where you should keep your cash when inflation strikes. The US Treasury is issuing Treasury Inflation-Protected Securities, or TIPS, as another option. These are available for purchase online through Treasury Direct in denominations as little as $100. 2. Real estate is commonly affected by inflation. In the long run, real estate is usually an excellent inflation hedge. Real estate is the ultimate hard asset, and it appreciates at the fastest rate during periods of high inflation. This is especially true as rents rise and people grow more interested in owning as a method to take advantage of tax benefits that help balance the overall amount of inflation. You can invest in individual properties, whether residential or commercial, or in REITs, real estate investment trusts, such as the Equity Residential, EQR, Trust. This trust owns about 300 major apartment buildings, mostly in high-cost regions such as New York, Boston, San Francisco, Southern California, Washington, D.C., and Seattle. Streetwise is our recommendation for REIT crowdfunding platforms. With a minimum commitment of just $1,000, practically anyone can participate in private real estate purchases through this website. If you expect growing inflation, real estate should have a place in your portfolio, no matter how you handle it. 3. Avoid fixed income investments for the long term. Long-term fixed-rate interest-bearing investments are the worst investments to make during inflationary periods. Any fixed-rate interest-bearing debt securities, especially those having maturities of 10 years or more, fall into this category. When interest rates rise, the value of long-term fixed income investments falls as investors flee the security in favor of higher-yielding alternatives. Should interest rates on newly issued 30-year bonds rise to 5%, the value of the 3% paying 30-year bond may drop by as much as 40%. When inflation and interest rates are low, long-term fixed income investments are ideal. If you think inflation is about to pick up, though, you should move your money out of long-term fixed income assets and into shorter-term alternatives, such as money market funds. 4. In equity investments, prioritize growth. Many investors aim to diversify their equity portfolios by buying high dividend-paying equities or growth and income funds, which can be especially effective during periods of market stability. However, if inflation rises, your investment returns may suffer. This is due, at least in part, to the fact that high dividend-paying equities, like long-term bonds, are negatively affected by rising inflation. Investing largely in growth-oriented equities and ETFs is a superior option. You should also focus on industries that will gain from inflation. These can include the following: energy, food, healthcare, materials for construction technology. Because all are expected to rise in value in line with inflation, they are expected to outperform other equity sectors. You can buy specific stocks with growth prospects or invest in these industries through an ETF fund. Energy equities, for example, can be purchased through the Sand, Oil and Gas Exploration and Production ETF, XOP, or the Vanguard Healthcare Index Fund, VHT. Once you've decided what you want to buy, you can do it through an E-Trade broker. 5. Commodities shine during inflationary periods. While there is no direct correlation between price levels and commodities, inflation has historically favored specific hard assets. Precious metals, especially gold and silver, instantly come to mind. You can own precious metals directly, such as coins or bullion bars, or indirectly, through exchange-traded funds, ETFs, that hold actual gold. You can also buy gold mining stocks or mutual funds that invest in these stocks. These are, however, stock exchanges, not physical metal. They're also notorious for being exceedingly volatile, even when gold prices are climbing. Energy stocks and funds will likely be a safer bet on the stock market. This is particularly relevant because growing energy prices are frequently one of the key drivers of inflation. We recommend opening a brokerage account with one of our top-rated brokers if you want to invest in commodities. You can trade directly through most full-service brokerage firms via a futures fund, options or an ETF after you have an account open. 6. Transform an adjustable-rate debt into a fixed-rate debt. Although this isn't really an investment move, it could be one of the most rewarding methods you can employ in the face of rising inflation. When borrowing money during periods of low or declining inflation, adjustable rates are preferred over fixed rates. When inflation rises, however, the process reverses. Higher interest rates result from higher inflation, therefore as inflation rises, your adjustable rates will continue to grow, possibly to unsustainable levels. If you believe inflation is on the way, you should convert your adjustable rate debt to fixed rate debt. Credit cards, home equity lines of credit, and especially your first mortgage, if it's an ARM, should all be considered. To find out what options are available, speak with your loan provider. It's also a good idea to look over your loan papers to determine when your rates may rise so you can prepare. When refinancing your mortgage, strive to keep the payback time as short as possible to prevent resetting your 30-year loan. Even if your monthly payments remain the same or increase, you will end up spending a lot less in interest. Inflation. Prepare your portfolio. Stocks have fallen as governments throughout the world try to flatten the curve of the coronavirus outbreak. There will undoubtedly be an impact on the global economy, but the extent of that damage is yet unknown. As the Federal Reserve eases its monetary policies, inflation is likely to rise. The cheap rates you're paying now could vanish in a couple of months, increasing your living expenses. One of the best methods to protect your cash flow is to convert them into fixed-rate debt today. If you believe inflation is on the way, repositioning is critical. This is especially true because, for at least the previous 3 decades, inflation has been low or declining. A change in direction, on the other hand, can be rather drastic. Any actions you may take ahead of time to prepare will pay off nicely in the long run. So there you have it, Thank you for listening, and click on our next video for even more interesting and motivational economic and financial news. Watch all of our videos. We take pride in bringing you the very best. You may not agree with me completely, so let me know your thoughts. I am Mr. Smart Money, reminding you to stay smart with your money. Watch our next video right now. I will see you in our next video.